This is the Real Estate Investing Abundance Podcast. I'm your host, Dr. Allen. I know you're excited to get into today's show, but I have a very exciting announcement to share with you before moving to the show. We've just launched a complimentary and comprehensive webinar that, among other things, shows you how to legally use passive real estate investing to reduce your taxes, recession-proof your nest egg, and take the sting out of inflation. If you are curious to learn more, go to stevetucker.com/webinar. It is complimentary and only takes a couple of minutes of your time. Once again, that is stevetucker.com/webinar. I'll see you in the webinar. Enjoy today's show. Hello, enlightened investors, and welcome back to Real Estate Investing Abundance. I'm your host, Dr. Allen, and delighted that you can be back with us again today. It is our audience that makes this show, and we love having you, and we love to hear from you. So take a moment to like, share, and comment, and also subscribe. Well, let's get into our show today, and with us is Dave Foster. And Dave is here to show us how we can save money using a 1031 exchange the next time that we invest in real estate. So Dave is the founder and CEO of the 1031 Investor, a qualified intermediary of the 1031 exchange. And he has over 20 plus years of experience working in all phases of real estate investing. So Dave, take us into the show and share a memorable experience that may have been key to being who you are today.
It's great to be here with you today, Alan. One of the things you'll learn about me, I have no problem letting others learn from my mistakes. Sometimes my favorite successories poster is that sign of the ship that's wrecked on the bank just outside the channel. And it says, sometime, maybe, the whole purpose of your life is just to be an example to others. So, but the memorable experience that just immediately popped up to me was the first and biggest mistake that I ever made in real estate investing. And it was my first one. My wife and I were in Denver, Colorado. Now, I got to set the stage because the whole story is actually where it ends. It's kind of cool. She's a Minneapolis city girl. I'm a Kansas farm boy. We met in Denver, Colorado. And the one thing that you don't see in any of that as a commonality is the ocean, beach, or sailing. But somewhere along the line, we had our first child, and we decided that in order to get off the corporate train, take advantage of the commodity that's most precious, time, and enjoy our family, we'd go learn how to sail and buy a sailboat and sail around the world. So there you go. With no background at all, we decided to do that. And also with very little background at all, we decided, like many people have, the best way to do that, real estate investing. So ready, fire, aim, Dave bought a duplex in Denver, fixed it up, did a great job, sold it, and was happy as a clam thinking we're on our way. Till my accountant told me at the end of the year that my silent partner, Uncle Sam, was going to get $30,000 of my profit. Well, that kind of caught me up short. Of course, that's no fun. And that set us on a search to find a better way to do it. Because I started to do, well, actually, I did these calculations just a week or two ago. I was thinking, what if I would have been able to take that $30,000 and invest it for myself instead of paying it to the government 30 years ago? At a 10% rate of return, that's almost $200,000 because of the reinvesting and the compounding of that money. My goodness, that would have been amazing. But I didn't. I paid the tax. And then, because I'm a nerd and a degreed accountant, I learned about the 1031 exchange. And that changed the whole thing. Because from that point forward, every time we sold a piece of investment property, we kept the proceeds because we used the process to purchase more investment property. And that let us ramp up our holdings dramatically. And then occasionally along the line, we would also carve off a sale by converting an investment property into our primary residence. And then 2 years later, selling that when the profit was tax free. So, between a combination of tax deferred exchanges under 1031 and primary residence sales, we were able in 10 years to buy a 53-foot sailboat with tax free cash, move our 4 children onto it, and raise them for 10 years, sailing all over while we lived off of the income from our vacation rentals that we had purchased with 1031 exchange. That was so profound as a life changer to us that I had to do it for others. And so that's what I've been doing now for well over 20 years.
Well, Dave, fascinating story there, and some interesting things. You met your wife in Denver, Colorado, and actually that is where I met my ex-wife now, but we also met in Denver, Colorado. So interesting and fascinating that you were able to take your children and actually live on a boat and travel around the world for at least 10 years of their life. What a fantastic way to raise children. And I mean, what a fantastic education they surely must have had.
Yeah, it's one of those things where you'll never regret investing in people and investing in memories. And so now, even that our children have kind of flown, we still all have this shared identity of something huge that we accomplished. And I think that that's going to be some glue for our family forever.
Oh, absolutely. Love to talk more about that. It just sounds fascinating, but let's get into real estate. So 1031 exchanges, a lot of our viewers know what those are, but not everybody does. So just give us the basics on what a 1031 exchange is.
Yeah, it's basically, it's a 100-year-old part of the tax code. It's been around since 1920. And the original purpose of it was to allow farmers who wanted to sell their farms to buy bigger farms. Many times back in those days, as we were transitioning into our industrialization, they discovered that they could not do that because by the time they paid the tax on their sale, they wouldn't be able to buy the larger farm. Now, that by itself, everybody, you want to think, well, they should be able to make enough money. It's not just that they couldn't do that. For every smaller farm that wasn't vacated, a young up and coming farmer couldn't get started. So basically, it was stagnating in our agribusiness industry. So Congress put it into effect that you could sell investment real estate and then, using this particular process, buy new investment real estate and not have to pay tax. Instead, indefinitely defer that into the new property. So, in essence, the government is giving you the opportunity to take their tax dollars and make the money for your benefit as long as you own the property. So, think about what that does for compound interest. Like I said, in my case, it was $30,000 compounded over 30 years that I get to use it. That's huge. So, the government wants a real estate industry has good velocity. There's buying, there's selling, it's active. In order to do that, they put Section 1031 in on the investment side to encourage people to do that. So we get to keep the capital gains tax. What does the government get? Well, the government gets the ordinary tax from 2 title companies, 2 painters, 2 appraisers, 2 realtors, and the list goes on. So it's a huge benefit for our nation in terms of creating an active economy. For real estate investors, what an opportunity to live and create a portfolio of real estate that's based on the government's tax dollars, but you get to make the benefit from it. So, I mean, it's as simple as that: selling investment real estate, following a particular process, buying investment real estate, and you get to indefinitely defer paying the tax.
Yeah, a good program. I didn't realize it had gone back that many years. But that's interesting. I certainly didn't know it was started with the farm program in mind there. Well, you
Yeah,
say that.
like everything good, I was going to say, just remember the IRS has to let you do things, but they don't have to tell you about it. So much
Yes,
of this stuff we just have to discover, don't we?
yeah, absolutely. Yes, yeah, yeah. There are a number of different things in there that most people are not aware of, and people who are not in real estate investing in particular have no idea of what they're missing out on. And I really believe that taxation is one of the things that makes real estate the ideal investment that it is. And if people don't own real estate, they lose money year upon year upon year that real estate could be saving them. Well, talk about time is our greatest commodity. You've already alluded to that in terms of the compound aspects of interest, but you say that we can uncomplicate our portfolios with less is more and consolidate our investments to maximize our returns. I have, I guess, some idea of maybe what you're talking about, but we may be thinking about two very different things. So tell us what you're talking about there.
Alan, I think what you just said was so key when you talked about the ability to defer in terms of changing our life and being able to realize that we don't have to pay that tax because real estate is the greatest way to avoid that. And that's just so key and central to this. And whatever the philosophy is that the government has had, they want America owning properties and building properties and increasing that. So the 1031 exchange really plays into that in a number of different ways. And, I can, right when you said that, I flashed in my mind the comment that I get probably weekly from people. And that comment is, well, but Dave, why do I want to do this? You said I'm just deferring the tax. I'm going to have to pay it someday. So why would I want to do it now? Why not just, rip the band-aid off quick, pay the tax and go on? And my answer is that there's 4 D's, as in dog, D's, that will constitute why you would want to do 1031 exchanges forever. The first D is defer. Because of that compounding interest, whether it's one day or whether it's 30 years, you get to keep the benefit of those tax dollars and make the return off of that. And then you get to make the return off of the return that you made off the deferred tax dollars. So no matter how long it is, you're going to get the benefit. So I would think that would be a good opportunity to say, I'm going to try to do that as long as I can. The second D I'll give you, it's defer. And that is because real estate, like everything in business, real estate is very cyclical. Now, nobody's got the great Carnax hat to be able to tell you when it's going to happen, but we pretty much know exactly what's going to happen and the way that it's going to follow. How real estate follows, what sectors heat up first, how sectors transition, when it's best to move from commercial to residential, when it's time to load up and buy a lot, when it's time to simplify and buy fewer, when it's time to change. Gosh, I wish I was one of those people that lived in San Francisco Bay and sold my stuff at the top of the market there to go follow that crazy guy named Elon and go buy cheap dirt in Austin, Texas. What's happened to all that Austin land? Wow, they have just benefited so much from that because the 1031 exchange will accommodate wherever you're at in a real estate cycle. If whether you're at the beginning and it's time for you to load up with lots of properties, you can sell one and buy two. Or whether you're at the tail end where it's time to start consolidating into larger properties, you can sell several to buy one larger property. You can move locations, you can move classes. Whatever the real estate market is telling you, you can use the 1031 to get there. And in doing so, keep those tax dollars working for you, just like the first D. So defer and defer. What do you think the third D is, Alan?
Um, I would guess it is depreciation is my guess.
Depreciation is a great thing that we get. Yes, when we own real estate, but it was kind of a trick question. The third D is also defer when we're talking about 1031, because just like 1031 exchanges can accommodate wherever the real estate cycle is itself, it can also accommodate wherever you are in your own personal life cycle as a real estate investor. I don't know about you, but when I was young, I had way more energy than money. So my real estate investing showed that. I was not scared to buy projects that took a bunch of hammers because I had energy and I could afford to get those cheaper ones. As life went on, I began to have less time and less energy, but more money. So the opportunities came in properties that I could use to purchase where I could take advantage of what I had. And, the consolidation exchange, as we start to get older, we start to like have things managed for us. So we move from active to passive. Again, all doing it with the 1031 so that we're continuing to keep that tax working for us. Retirement is a huge thing in everybody's life. If you want to retire and keep being a landlord, but you want your properties with you, then a few years ahead of time, you sell your rental portfolio in Cincinnati. Go buy properties down in Sarasota, Florida, so that when you retire, the last thing you sell is your Cincinnati house, and then you move to Florida. And there's your retirement portfolio right there beside you. How awesome is that? But here's where it gets even better. And this is one of those little known hacks that I hope your listeners will take today and think about. There is nothing that prohibits you from ever converting an investment property into your primary residence. As a matter of fact, there's a safe harbor from the IRS. So that couple from Cincinnati could sell their house up there. Now, when they do that, that's tax free. Go on a cruise, do whatever you want. But instead of using the money to buy another house, convert one of your rental portfolio into your next retirement house. When you do that, you now start a clock ticking where you're starting to reduce some of that deferred gain. And once you've owned that property for 5 years, once you've lived in it for at least 2 out of the previous 5, then you get to sell that and take a proration of the gain tax free. Yeah, tax free. So the real example would be I do a 1031 exchange, I buy a rental property, I rent it for 2 years. And this is just like I have a realtor down in St. Pete Beach. He bought 3 identical condos, side by side beachfront. Rented the first one for 2 years, then moved in. When he had lived in it for 3 years, he sold it. He got 3/5 of the gain tax free. When he moved in, it had been all tax deferred. All of a sudden, 60% of it was tax free. He paid a little bit of tax, which, as he said, if I was delivering pizzas or bagging groceries, I'd get a W 2 and pay taxes anyway. So this is okay because my retirement job is sitting on my back deck looking at the ocean. Hard to argue with that. But where do you think he moved, Alan? Next door.
Into one of the condos. Yeah.
Exactly. And whenever he decides to sell that one, again, part of that will be tax free. So that's what your retirement can look like if you continue to defer using the 1031 exchange. You can actually start to eliminate a bunch of that tax. Okay, we've got defer, defer, defer. I'm not going to tease you with the fourth D. It's not defer though. The fourth D is die. And the reason for that, although it's not my favorite topic, is that we're all heading there anyways. But what's key is that when you die, your heirs inherit your real estate at what is called a stepped up basis. They inherit it as if they paid market value for it on the day you died. So all of that deferred tax over the years is wiped out with your death. You don't pay it, your estate doesn't pay it, your heirs don't pay it, and they get to start over building their own life with real estate given to them by you that has no tax bill associated with it. So my answer, that's a long-winded explanation of my answer to those people who say, why not just pay the tax now? Because A, every day that you keep it, it's your benefit. And because B, you don't have to pay it. You can get some of it tax-free and give the rest to your heirs and never pay the tax.
Enlightened investors, if you haven't done so already, be sure and click that like button and also click that share so others can take advantage of the content. And finally, be sure to subscribe so you don't miss a single one of our upcoming episodes.
Well, some excellent ideas there and suggestions that I myself hadn't really considered in terms of the 1031, but I can certainly see how all of that is very, very doable. So in terms of looking at real estate and particularly the 1031 exchange, how do we take advantage of downturn markets?
Downturning markets can be a great opportunity, but they come with their own challenges. There's a poison pill with 1031 investing where the best time to sell your property and start an exchange is an up market, right?
Mm-hmm.
But that's also the worst time to find your new property and buy it because competition is stiff and finding the deals is stiff. Well, the converse is true as well. As a market starts to turn, it becomes balanced and then it becomes imbalanced. And now it's tougher to sell than it is to buy. So the best time to finish an exchange and find those value properties is the worst time to try to sell them. So my advice to people who are looking at the stage of the market they're in is to, first of all, consider that you've got to take what the market gives in total. Now, for people who love to invest and regularly invest, there are people that have abilities to find bargains. So you're always going to be able to find bargains, but finding unreasonable bargains in a market where everybody's buying like crazy is not going to be realistic. You have to understand that you're probably going to have to buy a property higher than you would think because you got to sell your property higher than you thought it should go. And the converse is true in a slowing market. People sometimes will have unrealistic expectations about what they should get for their old property, that they miss some good opportunities on the buy side because they're waiting for that buyer to come along who's going to pay the right amount of money. So sometimes it's beneficial to price your property a little more realistically in order to get a better deal on your purchase. Because the thing about the 1031 exchange is you cannot take title to your new property until your old property closes. So it's always a sell followed by a buy. And we have to honor that. So you've kind of got to look at the market and see, what's it gonna give me? But the opportunities really lie in changing geographies and changing classes of real estate. The opportunity to find those places that are going to be hot but aren't now. Or if I'm selling in a down market that I think is going to be down for quite a while, to go find a market that's still got some growth left in it. Maybe Saturn is putting a new plant in Huntsville, Alabama, and the city I'm at just is losing business. So I'll sell in 1031 into a better economy. Or what's very, very common is that different classes of real estate mature sooner or later in a market. Single family residential is always huge at the beginning, and then it gives way to multifamily. And we're right now at a stage in America where multifamily has been so picked over, it's tough to find really good buys. So, but now might be the time to sell that multifamily to go back into single family. Why? because people are having a tough time buying. Single family rents, they're kind of peaking. So it's tough to get more. But what happens when people can't buy houses to live in? The government always steps in with programs. So ahead of them stepping in with programs, position yourself with a portfolio of single family residential properties. So that when people become incentivized, they're going to come knocking on your door. And when they're incentivized, they're probably going to be willing to pay better prices. So it really comes down to looking at the market and looking at the type of real estate that you want to go in. And then just being happy with what the market gives you. Because it's not a short game. We're not speculators. You're looking at my long-term impact over decades that built the portfolio for you.
Well, let's pause for just a moment, Dave, and share with our audience how it is that they can get in touch with you to take advantage of your 1031 exchange services.
Yeah, there's a couple different ways. By the way, I forgot to ask at the show, but I think you're getting a copy of my new book, if you haven't already, that's coming to you, called Lifetime Tax-Free Wealth. It's the real estate investor's guide to the 1031 exchange. And a lot of the stories we talk about are in there. We do a ton of case studies from different types of people across different industries at different stages in their cycles to show how you can use 1031 exchanges. And then because 1031 is such a little known, as you're well aware, such a little known thing, but it's so powerful, we wanted to develop an education presence to help people learn about them as much as do them for people. So people can simply go to the1031investor.com. Check out our 47-part YouTube series, our articles, our calculators, talk to our consultants, and start to build that wealth that's going to carry you through not only this generation, but your next.
All that information will be in our show notes. But Dave, we are running out of time here. So if you could just real quickly take us through the 6 requirements of any exchange.
Perfect. Yeah. So requirement number 1, these all have to be met, by the way. Requirement number 1, it has to be real estate, and it has to be real estate that's held for investment, not fix and flips, property you intend to hold. Secondly and third are the timing requirements. From the start of your sale, you only have, or from the closing of your sale, you only have 45 more days to identify your potential replacements. And you have a total of 180 days to complete your purchase. You have to use the services of an unrelated third party called the Qualified Intermediary. That's what we do. And we have to be involved. This is so critical. We have to be involved prior to the closing of the sale. If you close your sale and then call me up next week, you cannot do a 1031 exchange. Big deal. Whoever the taxpayer is for the old property, or whoever is on deed to the old property, has to be the taxpayer or be on the deed for the new property. So that comes into play when you're changing business entities, some considerations like that. But in general, the way you own the old property, you must own the new property. And the final one, which is the toughest one to get, is that in order to defer all tax, you must purchase at least as much real estate as your net sale. And you must use all of the proceeds from your sale to do that. If you take any cash out, or if you buy less than you sell, like if you wanted to take out your original capital that you put down on it, the IRS says that what you're taking out is not your original capital. You're taking out profit, which is a dirty trick to play, but they're the IRS. They get to do it. So you purchase at least as much as you sell, use all the proceeds, and you'll defer all tax. And those are the 6 requirements. Now, as you can imagine, we just went over them in 2 minutes, and there's about 10,000 pages of case law. So there's a little bit of nuance in there, but they're not that difficult, Alan. And that's what's fun is I tell people the hardest 1031 you'll ever do is just your first one. After that, the benefits so outweigh any of the hardships in trying to do them that it becomes a fun game.
And the qualified intermediary takes care of all those complexities. It's really all you really need to do is contact your qualified intermediary, and it's
Yeah, we're kind of like
taken care
Gandalf
of.
guiding you through the mines of Moria, except we're the QI guiding you through the minds of the IRS.
Well, Dave, it's been delightful having you. Thanks so much for being with us. And enlightened investors, as always, thank you for being with us today. And don't forget to like, share, and subscribe. And please go to Apple Podcasts and leave us a rating and a review. Until next time, live abundantly, and we'll see you in the next episode.
Enlightened investors, wait, don't go just yet. I just want to remind you about our recently launched webinar that you will not want to miss. If you're at all curious and would like to learn more about how real estate investing can diversify your investment portfolio, alleviate the anxiety associated with Wall Street swings, leverage your 401ks and IRAs to substantially increase the return on your investment, and do all of this with turnkey, hands-off passive real estate investments, then you'll want to immediately go to stevetalker.com/webinar. In the webinar, we'll also address the common dubious investment schemes that you want to avoid. To access the webinar, go to stevetalker.com/webinar. I look forward to seeing you in the webinar.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steve Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid, passive real estate investments. As part of our efforts to make the world a better place, Steve Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steve Talker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at stevetalker.com.